Hey guys, Dave Keller here. I sat down not too long ago with David Auerbach. David is the editor of the Daily REITBeat. It's a real estate investing report. I met him at the Money Show in Orlando. We had a great conversation about real estate as an asset class. You know, most asset allocation approaches suggest that you have 5, 10, 15%, something like that in REITs or in real estate. And even though that's the case, I found most investors are actually relatively uninformed. They don't really understand what real estate does, what it means. Traditionally, you think of real estate as more defensive, right? It has a huge dividend component, tends to be a steady source of income for individual investors. Having said that, though, in recent years, at times, it's actually been one of the better sectors on a relative basis when you look at the total return. So it's a bit of offense, but also a bit of defense as well. So David did a great job in our conversation, sort of breaking down the return opportunities, especially the total return, the income component, but also some of the risks that you may or may not be familiar with. So ladies and gentlemen, here's my conversation with David Auerbach from the Daily REITBeat.
Hey everyone, we're here at the Orlando Money Show, joined by David Auerbach. David is the editor of the Daily REITBeat. Good to sit down with you, David.
Thank
appreciate
you for having
it.
me. I really appreciate it.
Yeah, you're in town from Dallas, Texas.
Yes,
Thanks for
sir.
making the trip. For those that don't know you and your work, can you just give us the quick background? How did you get to this point here?
I have been covering the REIT sector, that's the Real Estate Investment Trust, for over 20 years. I was at a firm originally called Green Street Advisors based out of Newport Beach, which is considered to be at the time was the preeminent REIT and research and trading company.
Right.
And I left Green Street several years ago to go build out the platform at a firm in Dallas called Esposito Securities.
Okay.
Left in December of 18 to kind of go off on my own and figure things out, you know, instead of working for the man to be the man. And I had been working on this Daily REITBeat Newsletter for about 15 years, whether I was at Green Street or at Esposito, and I realized there's a huge demand to give investors the information.
Yeah.
There's a gap between what the big sell-side bulge bracket firms put out to what the end investor is able to consume. And so my distribution list consists of many REIT management teams, the buy-siders, the guys that actually spend the money, the sell-siders, the guys that sell the research, institutional investors, individual investors. It tries to cover the spectrum. The goal is to try to get the information to the end investor.
Got it. And what was the moment when you started focusing on REITs in particular?
When I graduated college way back when, which isn't that long ago, 20 plus years ago, I started out in retail brokerage, like a lot of other folks, as you had mentioned that you were at Fidelity for a long time.
Yeah, sure.
And so I did retail for about a year or so, butted heads with my senior officer, and I applied to an ad in the paper, and it was at Green Street's trading desk in Dallas, and this goes back to 1999, 2000. And when I got hired, my boss at the time, my mentor, had said to me, kids your age don't get this opportunity. And so I had no idea what REITs were when I started in March of 2000. My colleague who hired me, I'll never forget, the day I started, he goes, don't get too comfortable. REITs are going to be gone in 5 years. This is not a very exciting sector. And every single year I make sure to email him, I'm like, dude, it's 20 years later, it's still there. And he's like, yeah, I missed that one. So it's not a very exciting sector. They only recommend you have like 5 to 15% of your portfolio involved in REITs.
Sure.
But in the big picture, I hate to say it, we're not getting younger, we're all getting older. And so as a result, we're all on that hunt for that edge. What's going to give us that extra yield, that income? Where's the excitement as we get older? And that's going to be found in REITs.
It's very, very interesting. You know, it's funny when you talk about income. I mean, a lot of people, I found, and I'm curious what you found. I found a lot of people still are very unfamiliar with REITs. They don't understand the different parts of it. REITs became their own sector of the S&P, I don't know, 6, 7, 8 years ago, I want to say. I forget when that was.
The breakout was about 3 years ago.
Okay.
When the REITs became their own REITs and real estate standalone sector.
Yeah.
I, at the time, thought there was going to be a whole bunch of new REIT funds coming to market because it's index-based, and that didn't happen.
Okay, right.
Instead, it made the operators get really more savvy and smarter with their existing portfolios.
Okay.
So to answer your question, yes, REITs aren't that exciting, but there's really great pockets of opportunity to look at how the market has developed over the past, call it 50 years, 60 years since REITs have been around.
Yes.
Now, sure, you have your office properties, your apartments, your strip centers, your malls, your self-storage facilities. But now thinking about the next generation, the millennial generation.
Yeah.
If you're a millennial, how do you play the REITs? Well, that's easy. You go out and buy cell towers.
Yes.
You go out and buy data centers where all this stuff in the cloud is stored. It's in data centers.
Yep.
So again, it's not exciting, but for a millennial guy, how can you take advantage of how things are shifting towards online or onto our phones? There's some opportunities that are out there.
So you mentioned some of the different types of REITs, right? There's office REITs, residential REITs, all of these. I think a lot of people sort of maybe incorrectly or maybe correctly think of REITs as one big thing. Is that a fair assessment, or is there differentiation between the types of REITs that people should know about?
That's a great question, and there's multiple different types of REITs. You've got the equity REITs, those are like the office buildings, apartment buildings. You have mortgage REITs. Those are the guys that do the lending. You want to go out and buy a house, there's companies that specialize in lending, and they're called mortgage REITs.
Right.
Much riskier, a little bit more riskier than the equity side. Okay. So it's a whole different valuation and a whole different beast than what people follow on the equity side.
Right.
You have what you call your public non-traded REITs.
Okay.
So they're registered with the SEC, but they don't trade on the exchanges.
Right.
And then you have your called private REITs.
Okay.
And personally, not representing everybody else, but my personal thoughts, if a broker tries to put you in a private REIT, do your due diligence. You do not want to get run over when a private guy decides to go public. And there's a lot of famous stories of private REITs converting to public and shareholder wealth just disappearing in the blink of an eye.
Interesting. It's when I think about real estate, I would traditionally think of it as a fairly defensive positioning, right? Because you have a big dividend component. But we've had the situation where the equity markets have done well, and real estate at times as a sector has done pretty well. How do you think of it, or how should investors think of it in terms of offense versus defense in their portfolio?
So that's a great point, because one of the things I've been talking about is the correlation between the REIT sector versus, let's say, the S&P, Dow, and NASDAQ.
Sure.
Traditionally, as the S&P, Dow, and NASDAQ continues to go up, the REITs have sold off. But as you have just mentioned, right now they're kind of going in lockstep with each other, which isn't a bad thing.
Right.
However, REITs are traditionally what they call a flight to safety.
Right.
So in terms of volatility, right now everybody's talking about coronavirus and there's, what's going to happen on the global economy.
Yes.
When there's fear that goes into the market, investors go towards the safer investments, commodities, gold, utilities, and REITs.
Right.
So yes, there's that inherent nature of the safety aspect of it, but then you have some high flyers out there. Like a great example is there's a cannabis REIT out there called Innovative Industrial, IIPR.
Right.
They're a first mover. They're the only people in the public REIT space doing what they're doing. And I don't consider that a safety type of stock.
Right.
So there are some anomalies that are out there.
Interesting. It's almost the lesson there is really be aware of what you're getting exposure to, right?
Just
There's
like
some
any stock
opportunities
that you're going to get into, do your research and figure out, is this the best investment for me? Because the other thing is, I was always taught when I was growing up that the long term is 30 to 50 years out.
Okay.
If you have a millennial investor sitting here or somebody younger, they may say to you, my long term is 5 to 10 years out, maybe 3 years out.
It's all relative,
it's
right?
All relative. So you really have to figure out what am I using this investment for?
Yes.
I was just sitting in a presentation with one of the public traded REITs, and they were talking about, it's not the today play, it's looking at a lease of 30, 50, 100 years down the road. And it's not the appreciation of wealth that you're making today, it's the wealth that you're going to hand to your kids and your grandkids and continue to funnel it down for the further generations.
Very, very interesting. One of this presentations you're making at this conference, the REIT machine, and I think thinking about how people should include it in their overall positioning in their retirement planning. What's the one thing you would tell people if they're thinking about REITs? How should they be thinking of it as part of their asset allocation decision? Where does that fit in, do you think?
It varies by investor as far as what the risk tolerance is concerned.
Okay.
The rule of thumb has usually been anywhere from 5 to 15% of your portfolio involved into REITs or that real estate sector.
Right.
There's guys that'll be out there to tell you do 20 to 30%.
Yeah.
There's guys that'll be out there to tell you, only do a couple of percent.
Right.
Regardless, income producing, dividend paying machines, it's right now, as of the end of 2019, the average REIT dividend yield was just around 4%.
Right.
Well, find me an industry, a sector that's going to pay an average of 4% dividends. So, that's a good safety type of investment.
And there are some that pay way above that too.
And
right?
Again, for those that pay way above it, do your due diligence because there's companies that are going through some issues. You're like, holy cow, this has a 20% dividend yield. There's a reason why it has a 20% dividend yield.
Okay, good warning, good lesson there. You also, in one of your sessions, talk about REITs and ETFs as well. How do you think about the ETF landscape, or how should an individual investor be looking at ETFs broadly speaking?
So there's a big brouhaha right now looking at ETFs versus mutual funds. And for those
Sure.
that don't know, ETFs, exchange traded funds, are what I basically call a publicly traded mutual fund.
Right.
If you buy a mutual fund, the net asset value, the value of your mutual fund is struck at 4 o'clock at the market close.
Yeah.
An ETF, I can pull up a quote and see where can I buy the stock, where can I sell the stock.
Right.
And an ETF is just comprised of a basket of securities like a mutual fund, but it trades on the exchanges. So
Right.
it's a great way to get exposure to 20, 30, 40, 50 different REITs in one basket. Taking a step further, there's a lot of sector-specific ETFs that are out there right now. So everybody talks about Amazon.
Right.
And what's a great way, if I'm playing Amazon, how can I be involved as a REIT ETF investor? And there's several ETFs that are out there. A good example is INDS. It's by Pacer Benchmark.
Okay.
It's the Industrial REIT ETF. And it was created basically because Amazon is a tenant of all of these properties. Here's a great way to play the industrial REITs.
Right, right.
Or because we're all on our cell phones and thinking about the cloud and data storage and servers, Pacer also has an ETF called Server, SRVR.
Okay.
And it's comprised of all the cell towers and infrastructure and data center REITs. Again, because Amazon and YouTube and Facebook all have a demand for these companies.
Oh, fascinating. I didn't even think about that. When we're thinking about ETFs, it strikes me that so many of these, and I don't know about the particular ones you mentioned, so many of them have been designed in the last 5-10 years probably. Yeah. They've been tested in essentially a cyclical bull market within a secular bull market. Are there any concerns that you would have thinking structurally about some of those ETFs? Is there a big unwind that would cause some sort of stability issue? Like, how do you think about that?
That's a two-part question because the bellwethers of the industry are VNQ, which is by Vanguard, and IYR, which is by iShares. And they're the two largest REIT ETFs that are out there. They've been able to weather the test of time, deal with fluctuations.
Yeah.
However, there's a REIT called Tanger Factory Outlets. SKT is the ticker.
Okay.
And it just got removed from one of the largest ETFs that are out there. It was State Street's Dividend Aristocrats. The ticker was SDY. Sure. Because Tanger did not have a certain market cap threshold on December 31st. State Street had like a 20+% position in Tanger. You're talking millions of shares that they had to potentially unwind out of the ETF. And so now, as a shareholder, knowing that there's this overhang of what's this guy going to do, there could be some unnecessary pressure on one of these underlying constituents. So again, do your research, know what is inside the ETF, what am I owning? In my presentation, I always caution, look at the top 10 holdings and what percentage of the ETF does those top 10 holdings make?
Got it. How concentrated is it?
How concentrated is it? Are you putting really all your eggs in one basket?
Right.
Or are you able to kind of spread it out throughout the portfolio?
Yes.
And so this is where the whole active versus passive comes in, because an active manager will sit there and be like, you know what? I don't like this quarter. We're going to take this guy out and we're going to put this guy in.
Yeah. It's such great advice. And I found just dealing with individual investors, so many, and even some advisors and others, you think about an ETF as a ticker with some exposure, but you don't do the next level down, really understanding what exposures you're getting. A lot of times there are unintended consequences, right?
Correct, but the best part about it is REITs pay dividends.
Yeah.
So if you buy an ETF, the ETF receives dividends.
Yes.
They pass it off to you as ordinary income, and you're paying your regular tax rate. And the structure of a REIT is, a REIT has to pay out 90% of the income that it earns as dividends to its shareholders.
Right.
So the management teams are aligned with the shareholders. And so whether you buy the ETF or the actual stock itself, you're still getting those dividends right back to you at the end of the day.
That's great. So we've talked about sort of the structure of ETFs and a lot of your experience with that. What are you seeing now? We're recording this early February 2020. REITs as a sector have been holding up very nicely with equities, at or near all-time highs. What is your outlook for REITs going through this year relative to other bets people could make? Where do you
If I knew the answer to that, I'd be on my G5 on the way to Fiji and see you later.
Fair point.
But in all seriousness, I was always taught, if it ain't broke, don't fix it. If the machine is in place, that things continue to go the way that they're going, which has been appreciation.
Yes.
Unless there's some global catastrophe, this coronavirus, whatever it is, becomes a much larger epidemic or pandemic, I don't see anything really that's going to hold it up. Because again, a lot of these REIT management teams have been around for so long that they've been able to deal with volatility and bad news and good news. And so it's really not focused, again, on that long-term vision. Where do I see this 5-10 years from now? I don't really care about what happens in 2020. It's where is it going to be in 2025 and 2030.
I love it. Good reminder of paying attention to the long-term view, right? This was fantastic, David. Thank you so much. It was a pleasure to meet you.
I really
Good to
appreciate
learn
it.
about this.
Thank you.